And so for the webinar, we have a recording of Mark Gold from the 2012 Top Producer Seminar. And Mark is the managing partner with Top Third Ag Marketing, and prior to that he had a 20-year career as a member of the Chicago Board of Trade. And so at the Top Producer Seminar, Mark spoke about the MF Global debacle and the lessons that farmers can learn from that. So we have a recording of him speaking there, and it's about 40 minutes long. And at the end of the 40 minutes, Mark will be on the line for a live Q&A session. So during the webinar, you can type your questions into the chat comment section, and then during the Q&A, I will ask those questions of Mark. So without further ado, we'll go ahead and start our recording.
Well, good afternoon, everyone. My name is Mark Gold, and I have the inevitable task of having to discuss MF Global with you today. I know there have probably been several people in this room that have been hurt by what happened with the bankruptcy, but we're going to try to give you some idea about some things to look forward to. The folks at Top Producer called me about 30 days ago and said, Mark, one of the things that's not on the agenda is MF Global, and we think it's important that somebody try to address the situation. We know it's tough because it's not a pleasant topic, and as a commodity broker, it has certainly made my life more difficult as well. Certainly, we were very fortunate at Top Third, we clear our trades through R.J. O'Brien. We weren't involved in the MF situation. I can tell you that a year ago, I was approached by MF Global, and they wanted Top Third to move their business over to MF Global. I knew the folks pretty well there, and let me preface this whole meeting by saying that anything I tell you here today is my opinion. Whether it's about MF Global, other brokers, politics, or whatever we get into here today, these are my opinions. By stating they're my opinions, I can't get sued. So I just want to make that very clear. These are my opinions. At any rate, MF Global asked me to come on board. MF Global had bought Refco. Well, I go back a few years in this business with Refco to the fact that my father, does anybody here know what Refco stood for? Ray E. Friedman. My father was Ray E. Friedman and Company's first tenant or first landlord in Chicago when they started the company in the 40s. For those of you that don't know, Ray Friedman was convicted after World War II of playing with one of the commodity markets. I think it was the potato market back then, or the onions. I think it was onions, and went to jail. It's also true that his wife went into Harry Truman's office with an attaché case with $100,000. She left the suitcase and walked out with a presidential pardon for Mr. Friedman. Now, since Refco was then taken over by family members after Ray pretty much retired, Refco didn't have, in my opinion, a great reputation. They had probably one of the longest lines of violations by the CFTC of any commodity firm that ever was. But when they went under, MF Global bought them. I couldn't imagine anybody wanting to buy that firm, but they did. So when MF Global approached me about clearing my business, I said, you know, what's the advantage to me? And they said, well, we're going to save you and your company an awful lot of money because our rates are a heck of a lot better than what you're getting now. And I made the decision that I was very happy at R.J. O'Brien. I liked the people. I trusted them. And I really didn't have that same warm, fuzzy feeling with MF Global. And despite the rate difference, I turned them down. Now, was I lucky? I don't know. Certainly, I'm glad I didn't go with them. But the fact of the matter is the bankruptcy has affected a lot of people. We're going to try to look at some things here today. Now, on November 1st, basically, MF Global filed bankruptcy. We came in from that weekend, and they were gone. 3 days before, S&P had rated them as not being in any real trouble. the CFTC and the Merck had audited them and said there wasn't any problems. Didn't matter, they went out of business. Now, what happened? There's an interesting story today. If you want to stop by the booth today, I can give you the link to the website. But an article just came out yesterday on what happened to the money. And frankly, it's even a little bit convoluted for me. They took customer fund, they put a bet on excess funds on the European market. When it looked like the Europeans had a solution to their debt crisis, that trade went bad. And in order to cover the losses, it was $1.2 billion in additional losses. It looked like they stole the money out of the customer segregated accounts. Now, it's illegal. Did Corzine know about it? In my opinion, he had to know about it. And he was, in my opinion, he's directing the underlings to get this done. Why Corzine isn't in jail today? Again, this is my opinion. If you're the largest fundraiser for President Obama, what are the odds that you're going to jail? In my opinion, pretty slim. When he testified before Congress, and he said, I don't know what happened to the money. If I was those senators, I'd say, you know what, go sit your ass in jail till you remember. I have no idea what these guys were thinking. The fact of the matter is, Corzine's walking around. Anybody's interested, I understand he's going back to the family farm in southern Illinois tomorrow to bury his mother. To me, you have to know a little bit about Corzine and the environment he came from at Goldman Sachs. You know, they do a lot of things and take a lot of risks at Goldman. They've obviously had a lot of success over the years. Corzine left them, took over MF Global, and wanted to prove to the world that he was just as good as those guys that he left from Goldman Sachs, and he can place some pretty wild bets and turn them into the investment banking power that Goldman Sachs is. Well, Mr. Corzine was wrong, and it took the company down with him. Now, I've been involved in the futures business since 1973, a long time, almost 40 years now. And I was always raised under the assumption that segregated funds were segregated funds, and if you had $100,000 sitting in your account, even if the firm went bankrupt, that those funds were safe. We now know that's not the case. Now, what lessons have we learned from all this, and how can we deal with it? The fact of the matter is that MF Global is gone. There was another article that just came out last night. The article claims that they have found 100% of the money now. This morning at the taping, Greg thought the number was 90%. I read the number as 100%. The reason they're not divulging where the money is because the two trustees on both sides of this issue don't want to release the data and don't want to release all the emails proving where all this is for legal reasons. Now, I'm not a bankruptcy attorney, and I can't tell you why this isn't being brought to light unless it's political. But the fact of the matter is, up till now, most U.S. clients have gotten back 70% of their money. There are firms out there today who are offering MF Global clients 90% of whatever their funds were. So if you had $100,000 there, you've already gotten back $70,000. They'll pay you another $20,000 and take over your debt, virtually giving you 90% back on your dough. Now, the only reason these firms are offering you 90% is because clearly they believe they're going to get back 100% over time. And they believe that risking this dough for a 10% investment, where else are they going to get 10% on their dough? Probably nowhere, but they're willing to take that chance. But I don't believe they would take that chance even for a 10% return if they didn't have a reasonable expectation of getting the dough back. Now, whether it happens or not, I don't know. The fact of the matter is, again, in my opinion, the day it happened, the Merck should have stood in and said, we're guaranteeing everything here. They didn't do that. One of the lessons we've certainly learned was that the Merck, as we'll get to this in a second, isn't guaranteeing the money, they're guaranteeing the trades. The first lesson we learned here is exactly that. The Merck is saying that if you have a transaction, a trade, they're guaranteeing that both parts of that trade, the buyer and seller, perform on it. But if you've got $100,000 extra sitting in your cash and the firm goes bankrupt, they're not guaranteeing that cash. Now, I find it interesting. I had a tour of some young pioneer farmers in yesterday at the Board of Trade, and they put up the nice new film that they've got. And there's this guy talking about the sanctity of the exchange, and he was saying that he was very careful not to say that the Merck isn't guaranteeing segregated funds anymore, which has been the watchword in this industry for 150 years. What he did say was that we're guaranteeing the trade and that you have to deposit money with the clearing firm or the clearinghouse. Well, that to me is a transaction. Whether you're depositing it at MF Global or RJ O'Brien or whoever it is, that's a transaction. And we were always told that that was good. Well, unfortunately, that's no longer the case. Segregated funds are not guaranteed. Now, is that going to change? Is Congress going to force them to do something different? I don't know. I talked to my mentor in the business, a man that's been a member of the Board of Trade over 50 years, one of the true legends in trading around. And I said to him, do you believe this talk about Goldman and some of the other firms starting a new exchange to guarantee the transactions of the money? And he said, absolutely not. He said, nobody is going to want to guarantee the dough anymore after what's happened. So where does this all shake out? I don't have an answer for that. But what we have to look at is that there is increased risk out there and that having segregated funds could be at risk. The cash funds that we talked about have been partially recovered. Whether it's 70%, 90%, or 100%, I personally believe that the clients will get back up to 90% very quickly here now. The other 10% I think is going to be tied up in litigation for the next 3 or 4 years. Now, depending on how much money you might have at MF Global, is it worth selling it off to some firm at 90% on the dollar, 90 cents on the dollar? That's a decision you're going to have to make. Personally, it's easy for me to say because it's not my dough. But if I was looking at 100% loss on November 1st, and I've got a chance to get that 90%, I'm taking it. I'm moving on to the next thing. I'll eat that 10% loss so I don't have the mental aggravation. I don't have the thing hamstringing me mentally, and I would get out of it and take the 90% and be done with it. I won't ask a show of hands here, but if you have an account with MF Global, I'm sure you've been getting these letters in the mail from these New York lawyers or entrepreneurs telling you we'll buy it at 90%. They want to pay you 90%, I give it to them. And then move on. The third lesson, how do I know where my money is safe now? How do I pick a clearing firm? As many of you know, I go on the road and talk to farmers all across America. And my busiest time is from November 1st to April 1st, when the farmers are out of the field. And for the 15 years I've been working with clients, I've always said, the money's safe. Segregated funds can't be touched. Well, again, now we know that's not the case. So how do I know where my money is safe? The first thing I would look at, and again, these are my opinions, who owns the firm? Is it privately held, or is it a publicly traded company? If it's a privately held firm, how long have they been in business? How many times has that firm changed hands in the last 10 or 15 years? If the firm hasn't changed hands maybe once or twice in 15 years, you're on a pretty good track record. RJ O'Brien was sold I think it was in 2005 or 2006. They bought it back about 2 years later. Now, R.J. O'Brien is a private company. If R.J. O'Brien goes under, Robert J. O'Connor is the first man to lose. And he will be losing tens of millions of dollars of his own money. Now, Robert J. Sr. is now 93 years old, I think, 92 or 93 years old. His sons and grandkids are now running the business. They are fully aware that it's not some shareholder loss, it's their family fortune that goes down if R.J. O'Brien goes down. Now, they're willing to take some risk, and Lord knows they had to put up tens of millions of more dough when MF went under to take on some of their introducing brokers. So they're deep into this game. How do they prevent themselves from going bankrupt like MF Global? Maybe one of the most important lessons I think I can teach you here today is call your clearing firm up and ask them if they allow proprietary trading in the firm. I know R.J. O'Brien does not allow proprietary trading in the firm. To the extent I'm looking at buying back my Board of Trade seat, R.J. O'Brien won't clear my personal trades. Not that they don't love me, trust me, they don't want the risk of me throwing a shoe on the floor. You have to find out whether that firm allows proprietary trading. In my opinion, I would be very cautious about having my money at a firm, whether publicly held or privately held, that allows proprietary trading. Because how did MF Global get into this mess? It was that Refco trader in Memphis that took them down for $150 million, which took down Refco, which started this whole chain from starting. So I would be very careful there. If it is a privately held firm, I would want to know who the partners are and what percent of the company do they own. Might be a little difficult getting that information, but you should get some answers. Is it more than 10%? Is it a majority? You can go on the CFTC website and look up the principals, and it will tell you whether they have more or less than 10% ownership in the company. If you look up Top Third, you'll see that it says under Mark Gold, I own more than 10% of the firm. That's an indication that my money is up at Top Third, and I don't want it to go bankrupt because that's my company. If it's a publicly held firm, it's much more difficult. And I have to be very careful here today because I don't want to leave you with the impression that the value of the stock is the one and only deciding factor on whether or not your money is safe. It isn't. But if it's a publicly held company, I would look at the price of the stock. And I would look at the price of the stock over the last 5 years. And if that stock is now fluttering around $1 a share, when it had been trading at $8 or $10 or $12 a share, I'd be a little nervous. Now, you're going to have to do your own research on that. There may be some companies out there where the stock value is under $2. Does that mean I would run and take my money out? No. How long has the stock been sitting there? Maybe it's been to $1 and it's come back to $1.50 or $2 a share. That's a decision and some research you're going to have to do on your own. But I believe in the publicly held companies, when MF went under, that share was around $1 a share. I don't know how anybody could have felt comfortable thinking that this company might not go bankrupt. In the past, even if it went bankrupt, you really can't fault people because if there was a bankruptcy, you assume that the Merc was going to step in and segregated funds were segregated funds. Well, again, now we know that's not the case, which means you guys have to know who it is you're doing business with. So there are plenty of privately held clearing firms today that will take your account. I don't want to give you a list, but if you want to call me, send me an email, I'll be happy to give you a list of 4 or 5 people, that different companies that I believe are pretty sound. I don't have any inside information of their books, so again, you'd have to do your own research. But I know that there's some good firms out there. There are some good firms that are publicly traded, where the value of the stock isn't great, and it's partially because of everything that's happened in the futures industry in the last 6 months. Doesn't mean I wouldn't do business with them. I can think of certain firms that have affiliations with grain companies, and I believe that most of those firms are okay. I wouldn't have any qualms about having money with a firm like ADMIS, for example. Now, I'm no fan of theirs. I'm personally not crazy about some of the people, but I have no reason to believe that the money wouldn't be safe there, even though the stock I don't think is doing all that great. But I would feel comfortable having my money there if I was an independent trader. But do your own research. I'm sure that if you start looking at the value of these publicly held companies, some of these companies will stick out like a sore thumb, and that they have been, there's been 5 or 6 different names associated with the firm in the last 5 or 10 years. And they keep acquiring or growing by acquisition and name changes of the firm, the underlying firms. I think that, in my opinion, again, is a bit of a red flag out there. So that's how I would look to pick a clearing firm. The next lesson is I would sweep your accounts on a regular basis. By sweeping the account, I mean that if you've just made a transaction, and let's say it was an options trade, you liquidate that position, and you've got a $50,000 credit, or a $10,000 credit, or a $500,000 credit sitting in your account, I would want to draw that money down immediately. Do not keep excess funds that you don't need to keep in your account. And I would sweep them by asking that firm for a wire. I wouldn't sweep it and ask for a check. One guy came up to me at one of my meetings I do around the country and said, I got caught in the MF Global mess. And he said, I really shouldn't have, because I asked them for a check the week before they went out of business. I got the check, deposited it, and the check bounced. So in today's environment, I'd ask for a wire. Know you've got clean funds. They may charge you $25 for that wire. Don't be penny wise and pound foolish. Spend the $25 and get the wire. Can you imagine? Well, I don't want to spend $25 on a wire, and you got a $50,000 check coming in and it bounces on you because you didn't want to pay the $25 wire fee? Like somebody said today, you guys will buy a $350,000 combine, but you won't spend $25 on a wire. You know? I don't get it. But the fact of the matter is, you need to sweep these accounts on a regular basis. How regular? Each of you has to make a decision on the type of trading that you're doing. If you have marginable positions, this makes it a lot tougher. And I don't know if I have a slide on this, but we'll talk about it now in case I don't. Many of you know that I prefer my clients to only have long option positions. Now, as it turns out, in all the other reasons I've been talking about options for the last 15 years, this is a new reason to want to use options. If you had a futures position on, and let's say you had $100,000 in a marginal position, MF goes under. Now, the report's coming out in a day or two, that report moves and you're frozen out, you can't even get out of this loser. Who knows what that, if that goes against you, what's the margin call risk? It's unlimited and you can't even do anything about it. You're out of luck. But if you had the puts on and you paid for those puts what do you know? If something's good, that put can only go worthless. And if the market goes down, you still have that position. You don't have to worry about a margin call. So here's another compelling argument for the options. Now, how much do you sweep? If you've got marginable positions out there, you've got to keep that account funded. And if it's, 100,000 bushels of corn or 25,000 bushels of beans, it's significant money that you have to place up in that margin account. And now if the market moves against you, you got to send in more and more dough. Well, if they go under, whose dough is that in a marginable account? Obviously, we don't know anymore. But if you own that option, you know that trade is good because the Merc is guaranteeing that trade, not the money. At Top Third, if you have an account open with us, we ask that you open up the account with $1,000. Yes, you're risking that $1,000. If R.J. O'Brien goes out of business tomorrow, you're risking that $1,000. I can no longer tell you that I can guarantee that money is going to be there. I feel pretty confident it will be, but the fact of the matter is nobody can offer that guarantee to me. Now, if you buy $25,000 worth of options, I'm going to ask you to send me a wire for $24,000. I'll go ahead and put, as long as I know you and we have a relationship, I'll put on that trade for you. You send me the dough. Now you've got $25,000 worth of options. You know you don't have a margin call. You know if R.J. O'Brien, God forbid, will go out of business, you still have that trade on. And you don't have to worry about where's the dough because that trade is good, as we understand it today. Who knows? Is the Merc going to change the rules again? God, I hope not. But as far as we know, that trade's going to be okay. If it wasn't, I would close my doors, say good night, Charlie, and go do something else. Because at that point, you can't trust the markets. But at this point, as long as the Merc is guaranteeing the trade, I trust them. Now, sweeping the accounts, if you've got marginable positions, it makes it very difficult. But if you've got an options position, and let's say you make $50,000 or $100,000 in that position, the day you liquidate it, I want a wire for $99,000. Let's keep $1,000 in the account. But I believe it's prudent today to sweep these accounts and to sweep them with wires. My guess is the wire fees at all the clearing firms are going to start to go up. They've been 20, 25 bucks. Then they go to 100 bucks. I don't know. Considering the amount of wires I believe they're going to be asked to provide over the next years, my guess is they're going to raise the rate. So what? Pay the 100. If it's 100 bucks, pay the 100 bucks, use the wire. That's a lesson that we've learned here. Don't trust the checks. Trust the clear funds. Lesson number 5. You have far more risk in not using these markets than in using them. Everybody in this room is a top producer. I'm guessing the vast majority of you have at least 1,500 to 2,500 acres out there. And if you split it up, half corn and half beans, times 150 bushel corn and 45 or 50 bushel beans, you have got millions of dollars of risk out there. I don't know how many of you were at the taping this morning. Certainly the tone of the taping was, if there's trendline yields, there's risk out there. Now, how much risk? Nobody knows. But there's risk. The question you have to ask yourself is, on that 1,000 or 2,000 acres of corn or 20,000 acres, whatever you have out there, can you handle the risk if we go to $3 corn? And if you can, fine. You don't need the markets. But if it's going to bother you either financially or emotionally, then I'd say the risk far outweighs, the risk of the crops far outweighs the risk you have in using the markets, particularly if you use the option and long option. While we're on that subject of long options, I'll repeat this until I'm blue in the face. Any broker that wants you to sell a call to pay for a put, hang up the phone on them. It's so much easier for me as a broker to tell you, listen, these options, I'm telling you flat out, it's 20 grand. And then the next broker comes around and says, you know, Mark's right. We got to protect the downside. Well, let's sell a call to pay for that put. And those puts are 30 cents. Let's sell a call for 30 cents. Now it's free. Congratulations, you just saved 30 cents. And how do they sell it to you? They sell it to you by saying, well, what's the worst that's going to happen? We'll sell a $6.50 call to pay for a $5.50 put. What's the worst that's going to happen? You're going to have to deliver $6.50 corn. Well, corn's at $5.50 right now. It doesn't sound so bad. Geez, get an extra buck. That's not the worst of it. If corn goes to $7.50 or $8.50 or $10 this year, if we don't have trendline yield, you got to make those margin calls all the way up. And then the broker calls you up and he says, gee, corn's at $8. We better get out of this thing. And you can't afford to write the margin call checks anymore. And then you lift the hedge and you take the $2 loss. And as I said yesterday in my meetings, when you lift that hedge, what have you just become by definition? A speculator. What are the odds of that decision being right? 7%. Now the market goes back down to 5, plus the $2 you lost on that options trade, and you netted $3 in a year. You could have had $8 for your corn. Why? Because you wanted to save 30 cents and you opened the door up for a $2 or $3 risk. Don't do it. There, as my grandmother said many years ago, sheep died years ago. There is nothing cheap that's worthwhile. There is an expense that you have to pay to do this right and to stay out of trouble. I don't want any of you guys to get into trouble. I want each of you guys and gals to take the stress out of this thing and to manage the risk without creating more risk. When you sell that call, you're creating more risk. Don't do it. And then my favorite is selling 2 calls to pay for 1 put. Guy said to me the other day, my broker had me sell 2 calls to pay for 1 put. And you know what? It worked out okay. I said, well, what would have happened if it would have gone the other way? Well, I guess I would have had a margin call. I said, no, you wouldn't have a margin call. You would have had a double margin call. Oh, yeah, I guess I would have. All to save 30 cents. You want to know how those bums in Chicago beat you? Just start trading and try to outguess this market and try to get cute. They will beat you 93% of the time. Don't do it. So in my opinion today, you have far more risk in farming than you do in using these options. Again, this morning I talked about at the meeting, many of you or some of you may have dealt with an ethanol plant that went out of business after you had delivered the grain and hadn't received a check, or maybe a grain elevator. You have that risk that the firm could go under, a commodity firm could go under, just like the ethanol plant, or just like the elevator. If you had delivered corn to an ethanol plant and you didn't get paid, the company went bankrupt, should you stop farming because of that? No. You need to find some place you can do business, but you won't have that risk. So in my opinion, you have a much greater risk in watching corn go to $3 or beans go to $8 or cattle go to $100, let alone $80, than you do in trading in these markets and having an account open and managing this risk. Again, we've already covered this. Minimize the risk by using these long option only. That way you don't have to worry about the margin calls. You don't have to worry about the liquidation. If you're long the put, that trade is good. Investigate your clearing firm. Again, I would talk to, not only would I do that research in terms of the stocks, but I would certainly take a look at who does your neighbor use? Who do they trust? What's the relationship like with their broker? You've got these risks out here today that you've got to be more careful with. And certainly investigating means more than it used to. And again, I would take a look at the value of the stock. I would look at who owns that company and be very careful. I think the last thing, we're probably going to be able to get out of here early, but is to review all third-party risks, not only in the commodity business, but where you're dealing grain. Who are your suppliers? Who are you writing these checks out to? MF Global has taught us the lesson that no matter who it is you're dealing business with, whether it's a supplier, you've written out a check to buy X amount of pounds of fertilizer or X gallons of diesel or whatever it is, how do you know you're going to get the delivery? And that money, that check isn't going to get cashed. You don't know today. But what you can do is start looking at those risks. Who are these people? Who is that grain elevator you're selling grain to? Who is that supplier? Bob talked about it in the meeting this morning. Third-party risk is significant. It isn't like when I grew up in agriculture in the 70s, you know, a handshake was pretty darn good. You didn't need contracts, you had a handshake. Then you went to contracts. And now you find out these contracts may be worthless as well. So times have changed. Technology and other things have changed. You guys have got to keep up with it. And I know when you're out there on that planter this spring, the last thing you want to worry about is that diesel going to make it to my farm on time? Or is that seed going to make it to my farm? Or whatever it is. But that's today's life, folks. You have to be prepared to know all of these third-party risks, if they're significant, and if they go under, what's it going to do to you? Now, along this line, you want a third-party risk, go trade derivatives. You're going to be hounded by people in the grain business, commodity brokers. You don't need the exchange. Trust us, and we're going to do a derivative. Good luck. Do you really want a trade that's not guaranteed? Now, I don't care how solvent the firm is, how good they look. If what has happened to some of the firms in the United States in the last 5 years that have gone bankrupt, I'm telling you, anybody can go bankrupt in this country. Any firm. And you want derivative trades on. You've written the check. You think you got the risk covered. Corn's at $3 a bushel. And they say, well, sorry, we're not guaranteeing it. We thought the other party would be good for it. Good luck. It's going to be an easy sell to you guys. Listen, you want to do this swap or you want to do this derivative? Just deliver us the grain. We'll take care of everything. You better get a check or a wire that day for whatever you think that price is going to be. And if you don't get that check or they won't guarantee it, don't put on that trade. For the most part, if you want to look at what has caused the instability in the mortgage market, in the equity market, with Bear Stearns, with Lehman, with all these firms that have gone under, and MF Global, I'll tell you the one word they all have in common: derivatives. And they've let all of this banking laws get so loose, and they sound so good. 6 months before Corzine blew out MF Global, he's in front of the CFTC explaining to them how risk-free his derivatives were. And the CFTC said, oh, okay, go ahead. What nonsense. So these are the risks that I see that are out there. It's made my life much tougher. I can't go out to a meeting today and say your money's safe. I can only tell you that I believe that at a firm like R.J. O'Brien, and there's many others that are still standing, that are reputable firms, that you've got to look at still using these markets. You can't turn your back on it. You've got to manage this risk. If $3 corn or $8 beans is going to bother you. And again, you could sell futures. You could do if you want to do cash contracts at the elevator, that's fine. I have no problem with a lot of the cash contracts that are being offered to you guys. Take advantage of it. You want to sell grain, you want to sell all your grain today, go sell it. Buy back a call option in case we go to higher prices. But the fact of the matter is, for those of you that were in the meeting yesterday, I'll repeat myself here. I don't know how high prices can go if we have a drought this year. If we're below trend line yield. Can we go to 8 or 10 or 12 buck corn? Sure we can. If we have trend line yield, I can tell you exactly how low we're going to go, and that's back under the cost of production. That's where we've always gone. When beans went to 16 bucks in 08, we went to 7.90, right back under the cost of production. And why will that happen? Because the market is truly there, not for hedgers or speculators, as you've been told. It is there to force out inefficient producers. And the easiest way to force out an inefficient producer is to get the price of the commodity back under the cost of production. And that's what this market is trying to do right now. Doesn't mean it can't go to 10 bucks this summer first before it goes back to 3. But I'm here to tell you, every time we've had a major spike in the market since 1972, we have always gone back under the cost of production. Every time. To try to force out these inefficient producers. And who are the inefficient producers? These guys that are paying $15,000 for land or $500 or $600 cash rents, locking those prices in and have them protected the next 2 or 3 years of prices. Because when the prices go back under the cost of production, again, what's that land going to be worth 2 or 3 years from now? It ain't going to be worth $15,000 an acre. As a businessman, I've been asked plenty of times in the last 3 months, gee, Mark, should I sell my farm? They're offering me $12,000, $13,000, $14,000 an acre. And my answer as a businessman is one word: sold. My answer as somebody who works with the American farmer and understands the legacy of that farm and what it means to you and your family and what it means to agriculture, it becomes a much more difficult situation to say sold, knowing that that family farm's been in your family for 4 or 5 generations. And the greatest fear is that if you unload it, you'll never get it back. And maybe you won't get back those specific acres, but I'm here to tell you, when we go back under the cost of production, 2 or 3 years from now, you'll be able to buy that land back at a hell of a lot cheaper price. Just go to Florida for 3 years, come back, and see where you're at. And my guess is you'll be able to buy those exact same acres back for a less price. Now, I am certainly not advocating you all go sell your farmland. And don't walk out. Do you hear Gold tell everybody to sell his farm? I'm not telling you to sell your farm. What I'm telling you is, with today's environment, you've got to manage this risk. So when we do go back under the cost of production, you're not forced out of that land 2 or 3 years from now. In 2 or 3 years from now, you want to be in the position to be able to buy more land and take advantage of that opportunity. Somebody on the stage today said, when corn's down there at $3.50 or $4, that's when you want to own something. Do you really want to own it at $6 or $6.50? If you do, you better keep a put underneath you to protect that. But those are the risks that I see out here. I don't know how we're doing on time. I think we're a little early. That's okay. The government makes me tell you everything I talked about, I believe, to be accurate and reliable.
All right. Well, that concludes the recording of our webinar. Mark, are you on the line?
I am. Can you hear me?
Can hear you great. All right. Well, for our attendees, you can put any questions for Mark in the question comment area. And so, Mark, I think it'd be good to start again with what's an update on the MF Global situation?
Well, probably the biggest update is I mentioned that, I really felt that the Merck would be the first one to do something rather than the CFTC or the government. And right about the time we had that seminar, the Merck came out and said that they were going to guarantee each farm hedge account for $25,000 and that they would guarantee commercial grain operations for $100,000 per account. Now, that's certainly a step in the right direction, but in my opinion, a long way from where it should be. But at any rate, that's probably been the biggest development, that there is some backup for accounts. But again, it brings up the point that if you are carrying, balances over that as an individual over $25,000, it's certainly prudent to sweep the account from time to time and get under that $25,000 level.
And speaking of sweeping your accounts, are there any other kind of best practices or things that you should make a conscious effort to do to check your accounts and to make sure everything's in tip-top shape?
Well, I believe that there's some indicators out there, looking at the value of the share price of a publicly held company, and I wouldn't hesitate but to even check that tonight on some of the firms that are around out here. It's certainly a red flag in some cases that something may be amiss and you might want to get your money out, sooner than later. But again, the red flags that you look for are there any delays in wires? If you've requested a check, has there been any delays in those kind of things? Aside from that, just knowing who you're doing business with and what shape that company is in, whether it's privately held or publicly traded, is key to knowing, whether or not you've got a potential problem on the horizon.
Great. And, with this MF Global situation, from, a farmer end, it seemed to happen so quickly. It just happened suddenly that there were rumors and then boom, it had happened. Were there indicators or red flags of this situation that perhaps farmers or other traders or the overseeing facilities could have noticed?
Well, again, I think the value of the share price. The stock went from about, I think it was $7 or $8 a share down under $1 very quickly. And when, these stocks start getting under, $2, $1.50, $1 a share, it's certainly a red flag out there. So I wouldn't say that it was totally unexpected had you been watching the share prices.
Gotcha. You mentioned that a farmer should assess the risk that they have with those they do business with. And I was wondering if you had any more advice on how farmers could really take a hard look at who they do business with and figure out where the potential risk could be.
Well, as I mentioned, I think you have to take a proactive approach. Try to get on the board of directors of your ethanol plant. Try to get on the board of directors of your local grain co-op. Take a look at the financial reports of those people that you're buying product from. So if you write out a big check, are you actually going to get delivery of that fertilizer or seed? Now, the vast majority of the firms that the American farmer is working with today are in pretty good hands. But you still want to be proactive. Try to either get on the board or talk to board members and get a more personal feel for the actual financial condition of that company.
Great. On a personal note and as a professional in the marketing world, what would you say the MF Global debacle taught you?
Well, it certainly taught me that, for the 40 years or so I've been involved in commodities, we were always under the impression that customer segregated funds were guaranteed by the exchange. We've now found out that that's not necessarily the case, that the trades are guaranteed but not the cash, which seems to me, I'm not quite sure how they're doing that, but in effect they've walked away to some extent. Some of the money's been recouped, and matter of fact, a fair amount's been recouped. Somewhere between 70 and 80% looks like it's back in the client's pockets. But the fact that it should have been made whole the next day and it wasn't, to me, is probably the biggest surprise out of all of it. Again, because of what the exchange did or didn't do, you've got to be very careful about keeping money up at accounts and being more proactive in what you're doing. And again, I think, the more complex you make it by using derivatives or other products, it just opens up another layer of potential risk that I don't believe most farmers need at this point.
Great. What would you say to a producer who is now a little gun shy of the market and of trading because of the ramifications of MF Global?
Well, again, I think you have to ask yourself the basic question. Do you have more risk in farming without using risk management tools, or do you have less risk? In my opinion, there's far less risk in using these markets and helping a guy manage the risk of his farm operation than in losing huge sums of money through a firm going bankrupt. I don't know that we're done with commodity firms going bankrupt. There could be one or two on the horizon that are going to go under. Again, we've seen other, just because certain banks have gone under doesn't mean you should keep your money in a mattress. You've got to know who you're doing business with, and you've got to make the decision for yourself. If corn can go to $4 or $3 a bushel, or beans can go back to $10 or $8 a bushel, is that risk too much for you to handle, either financially or emotionally? And if it is, then certainly using the markets can help minimize that risk while not exposing you to a lot of additional risk, as long as you know who you're doing business with and a little more prudent about it than you have been in the past.
Great. All right. Well, I'll remind attendees to put in any last-minute questions for Mark. And Mark, speaking of grain prices, we have some big reports coming out on Friday this week. How would you advise farmers to prepare themselves for going into the reports, both the prospective plantings and the grain stock reports that are coming out on Friday?
Well, you've got some folks who believe that the grain stock's going to be friendly out there. I'm not sure I agree with that, but there's certainly some professionals out there that believe the government's underestimated the usage and overestimated production out there, so grain stocks could be tighter. On the acreage side of the coin, I believe we're going to see huge acres. The weather's been ideal. I believe we're going to see somewhere north of 95 million acres planted. If we continue with this kind of spring weather that we're having around the country, the number could get even bigger. Most people believe that we're going to lose soybean acres that are going to go into corn. I disagree with that. I believe this rally in the soybean market isn't going to draw acres away from corn into beans. I believe it's going to draw acres away from cotton and rice and wheat into soybeans. So people believe that maybe the corn's going to be big, but the soybeans, it's going to come out of soybeans. I disagree with that. I believe corn and bean acres are both going to be up. I think they're going to be big numbers, and my advice to producers would be to protect yourself with a put option. Spend 30 cents on corn, spend 50 cents on a bean put option to protect the downside, and hope that I'm dead wrong and for whatever reason the reports are bullish and you lose that 30 cents on the put option. You've got to think of it as an insurance policy, and like any insurance policy, you pay premiums every year for life insurance. Do you want to lose those premiums every year? Of course you do. You don't want your wife to collect on the policy tomorrow. And it's the same thing with these put options. It's an insurance policy. You hope the market moves higher, but if there's a problem out there, you've helped balance the risk.
All right. Well, that's some good take-home for our attendees today. So, Mark, thank you so much for giving us your insight today on a really big topic that not a lot of people are willing to talk about.
Well, my pleasure. I hope we brought some information that the American farmer can use out there.
All right. Well, that concludes our webinar for today. So thank you to everyone for attending.